So we could indeed have up to 10 trillion of stock being held on margin. If that's the case, falling values, and I would include Bitcoin in this, likely to trigger automatic selling, if you like, as the value of collateral backing those loans diminishes. Holding stocks is getting a very, very dangerous game. I think we could be in for a period of enormous volatility, and I think it's important to understand why that volatility is there, and then you can probably navigate your way through it.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 17th through November 24th, 2025, while supplies last. First this week, backdated 1-ounce gold buffalo are just $320 over spot per ounce. Next, pre-1933 MS63 $20 Liberty coins are just $150 over melt per coin. And finally, 1-ounce 2025 Silver Eagles are just $7.85 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always privileged to invite this distinguished returning guest. Alasdair MacLeod is a former bank director. He's also a former head of research. He now runs his own Substack at substack.com. Alasdair, thank you for joining us on Liberty and Finance.
That's my pleasure.
You've spoken with us several times in the past about the credit bubble, a crisis really that we're in, and how it is bound to end badly for many who are assuming that it won't. The markets themselves that you study closely are exhibiting nervousness about the condition of risk, and you have several examples of that. Could you first talk to us about the nervousness that you're seeing in the markets?
Yeah, there's sort of there are sort of mixture of things going on. I mean, we've had no statistics out of the US government that not quite no statistics, but certainly statistics that people follow, like employment statistics and so on and so forth. They've been suspended. They're about to come back. There's nervousness that those statistics might show that the economy isn't performing as well as people hope or think. On top of that, of course, we've seen Bitcoin fall very, very substantially. I mean, remember at one point it was $126. Today, it dipped below $90, though it's recovered a little bit since then. There's been a sort of talk about the Magnificent Seven and how they seem to be losing momentum, sort of concerns there, and so on. So there is this nervousness. But underlying it all, of course, is the condition, the overall condition, and that is one of a credit bubble fueled by bank credit, the expansion of bank credit to, if you like, help people buy stocks and thereby drive their prices up. We had released earlier this week, I think it was late, maybe at the weekend, the FINRA's margin lending figures. And they're now about 1.2 trillion. That was the October number, end October. Now, bear in mind that that's only brokers lending to their clients, margin lending. Now, some of that they will have done out of their own resources. Remember that a broker can't actually lend credit into existence. That is, you have to be a licensed bank to do that. So where a broker doesn't do it out of his own resources, he will do it out of a bank. He will draw down on a client's loan account. It'd probably be a general loan account with a banker. But on top of that, of course, you've got hedge funds and you've got the sort of very large institutions, the very large family offices. Some of them will have gone to the banks in order to leverage up their positions. So the idea that there's about 1.1 trillion, 1.2 trillion of margin debt actually only tells part of the story. A far larger amount is being loaned and we don't see it because it's not recorded in those FINRA statistics. And, when a bank or a broker lends a customer a credit on margin, I mean, it's usually to buy about 3 times as much stock. So there could be, I mean, on FINRA alone, that's about $3 trillion worth of stock. And then with the banks, I don't know, you could probably take a guess. You probably at least double that again. So we could indeed have up to 10 trillion of stock being held on margin. Now, if that's the case, falling values, and I would include Bitcoin in this, likely to trigger automatic selling, if you like, as the value of collateral backing those loans diminishes. So you can see it's quite a febrile situation. I mean, if you look at Bitcoin, I mean, falling from 126 down to 90 odd, I mean, that's over 25% fall. And there are some very leveraged positions in that. So you could get, if you like, an avalanche of sellers developing if that situation gets worse. Now, we don't know for certain that this is the end of, if you like, the credit bubble, because one of the things the Fed was doing was it was changing its policy from trying to control inflation to, if you like, providing liquidity in the system. And to that end, it has announced the end of QT and the beginning of QE. So, you know, the credit machine is going to get cranked up again, another notch. But whether it's enough to save the equity market, we will see. We don't know yet. We always know these things in hindsight. But I think the general point is that holding stocks is getting a very, very dangerous game. And, you know, I've been saying for some time on your program, you know, I would get out of credit and get into real money, which is gold. And interestingly, once this market turns, once the bubble gets popped and stocks really start sliding, virtually everything will go with it. So if you've got mining shares, you'll probably find they get quite a lot cheaper in the process. Nothing to do with gold or silver, but just to do with the general distress in the market. Gold and silver, last time this happened, we were looking at the great financial crisis, 2008, 2009. Gold was sold down from $1,000 down to about $680. So it then went on after that to go up to $1,920, which was a significant move, you know, once the immediate crisis had passed. But we could have the same thing today, but I think it's less likely because central banks are in there taking opportunity. Any stock that comes out, they will buy. So I think that the physical market, it's unlikely to suffer the sort of problems that we saw in late 2008 and into 2009. Mining stocks could be different, though, because there are some very substantial profits there. And what people do when things start going wrong is rather than sell the things that, you know, and realizing losses, what they do is they hang on to the rubbish that they're making losses on and sell the good stuff, which will be mines, of course. So I think we could be in for a period of enormous volatility. And I think it's important to understand why that volatility is there, and then you can probably navigate your way through it, at least better than if you did. Let's put it that way.
You were pointing out some similarities in the setup between now and right before the global financial crisis of 2008. You mentioned that there are some differences. What about the other difference of the rampant accumulation of physical gold, these programs that have been going on for years now, at least 4 or 5 years by the central banks of the world? Is that a significant different backdrop for affecting the physical metal outlook going forward through this volatile time than the way the setup was back in 2000, prior to 2008?
Yeah, it does make a huge difference because the central banks undoubtedly will be in there buying any physical gold that comes on offer. And I think the answer is there won't be any coming on offer. It'll all be in the paper markets. That's where the volatility will be, if you like. But interestingly, if you look at the open interest in COMEX at the moment, just to take futures market, it's sort of not that high. I mean, it's sort of average to slightly less than average, which suggests that the amount of speculation, the amount of if you like, momentum trading, speculative trading, and so on and so forth in the futures market is actually not all that great. So, the idea that they could sort of maybe bash it down and really shake the trees, as it were, get out to all the loose holders, that doesn't really apply in this situation. So it is a fundamentally different situation. And of course, the other thing is that, I think this is a topic you might like to follow up on. China is definitely making a move to make gold exchangeable for yuan by opening vaults outside China. SGE vaults are being opened in Hong Kong and also in Saudi Arabia, and there will be facilities in other Southeast Asian nations. So the whole of the BRICS cohort, as it were, will be looking at a situation where, for trade purposes anyway, the yuan and gold will be exchangeable, and presumably at some stage in the future there will be a fixed exchange rate. So if you're an African central bank, it does make sense that you've got to start accumulating a bit of gold. If you've got mines in your territory which produce it, you'll hang on to it, which will leave the market short. If, on the other hand, you haven't, then you've got to go into the market and try and get some. So I can see that central bank demand for gold is probably going to accelerate. And the other side of it is that following the debacle earlier this year, when the Bank of England had a rush on its vaulted stocks, I think the central banks who saw their leased gold walking out of the door will think, I don't think we really want to do this in future. So I think you'll find that gold leases, which are essential for the liquidity of the forward market in London, I think the availability of those leases is going to diminish. I suspect it's already diminishing. And I think that the bullion banks are already aware of this, which is why they're quite happy to talk the price of gold up now, just as the major banks are. You get Morgan Stanley and so on now openly talking about higher gold prices and talking about, well, you should have 20% in gold, I think in the case of Morgan Stanley. Things have changed hugely, but it's just that, when the equity bubble pops, there's going to be a lot of widespread fallout in all sorts of different things which are not directly related.
Yeah, if I can summarize that first part, my takeaways there were you're saying that there's rampant speculation and margin leverage being used in the stock market, and you foresee that adding fuel to the fire of volatility that's driven by a collapsing credit bubble. In contrast to that, you're seeing steady and growing demand for physical metals as a safe haven harbor and as a new international settlement method backing by the countries of the world and the central banks of the world. And these stand in stark contrast from both a risk standpoint and a likely fallout of the volatile times ahead. You touched on the new BRICS pay. The number of countries just this last week announcing moving into alignment with the BRICS nations, signing up for BRICS pay and the new currency methods related to that. Any further follow-up from you on what that development is? What's new in that arena that people should be aware of?
Well, I think, the background to it is that, as I said just a moment ago, the Bank of China is now extending facilities outside China whereby yuan can be exchanged for gold. That's the whole point about the new SGE vaults, which are being opened outside China. They are exclusively for the exchange of gold for yuan and vice versa. So that, I think, is a very clear signal that in the future, trade settlement on a national basis, if you like, what it's called international, between nations, will be on a yuan which is tied to gold. And it looks to me as if it's going to be, if you like, a modified version of Bretton Woods, where Chinese nationals or indeed nationals in a BRIC nation can't sort of go along to a bank and say, I want to change these yuan for gold or whatever at the exchange rate. I think it will be just available at the international level between nations. That's the whole thing. It'll be for trade settlement. I mean, that is absolutely clear. If you can't see it, then, wake up, for goodness sake. It's all there in front of us. But what it does mean is that all the members of BRICS, who on the one hand are terrified of, having their dollar loans called in by the Americans or regime change forced upon them. I mean, this has been the history, if you like, of American imperialism. They're really quite careful in what they're doing, walking a bit of a tightrope on this one. But they can see which way this is going, and it does encourage them, I think, to get trade settlement arrangements in place. Hence signing up for the Chinese exchange trade settlement system. They've rather got to do that, and I think very, very quietly they're doing it, and very quietly they're looking to beef up their gold reserves as well, because they will need them in this new world. I mean, what we're looking at is a post-fiat currency world. It's not just me who's been saying it. It's, I think, some of the smarter heads, if you like, in central banks. They know what's going on. They may not be able to do anything about it, and they also follow policies which they know to be wrong. But these guys aren't stupid. They understand the difference between money and credit. And consequently, they're going to protect themselves against a complete collapse of the fiat currency system, which is what we are moving towards. And you can see how that's going to happen too, because when this equity, or if you like, the financial asset bubble pops, and this is particularly the case in America, then you're going to get a collapsing stock market. You're going to get collateral problems, which I've just described, through all the margin loans being foreclosed on and all the rest of it, which will increase the selling into a falling market. And at the same time, you're going to see businesses faced with higher refinancing costs, banks reluctant to lend anything into the private sector. So, this is going to, if you like, hit the non-financial private sector very, very hard in terms of cash flows and all the rest of it. Consequently, we go into a slump. Now, what does the US government do under those circumstances? Well, the answer is quite simple. It stands there to rescue everything and to stop a slump happening, and indeed, if possible, to stop even the stock market sliding. How do they do that? By debasing the currency. And they debase the currency not by suddenly announcing a new rate of exchange to gold. What they do is they just print, and they're already doing this. This is the whole point about the Fed changing tack from worrying about inflation to saying, okay, stop QT, start QE, interest rates are secondary. But the point is we've got to get liquidity into the system to stop it falling over. That was what the Fed was doing. I mean, it was a very clear signal to all of us where the priorities now lie. I mean, one of the things that's been sort of undermining sentiment in the market a bit is we were absolutely certain that we were going to get another cut in the Fed funds rate in December. Now it's 50-50. So you can see that there are doubts creeping in, if you like. But the interest rate scene isn't so important. What really matters is what the bond yields do. And what the bond yields will do is they will start discounting the growing certainty that there's another round of dollar debasement about to occur. I mean, when you get dollar debasement, what sort of level are you going to demand in terms of return to part with your dollars, say, on a 10-year basis? Is 4.5% enough? Probably not. That's the problem. You're going to have rising borrowing costs against an economy which is suffering from the fallout of, if you like, an equity bubble implosion. And it'll destroy the currency. It is as simple as that.
Well, destroy the currency with the full participation of the central bank at flooding the liquidity, so they're shooting themselves in the foot and shooting us all in the foot by flooding the currency supply with liquidity in hopes of rescuing the system. But that just is a signal to all those who are in the know that the game is up, and the future return on any bonds darn well better compensate for that intrinsic debasement of the currency, and therefore that any hope that bond yields won't spike, it goes out the window. This lack of trust in the currency is also related to something we wanted to ask you about as a former bank director. There's been strains in the interbank overnight lending, the repo market, not related so much to liquidity, but just loss of trust, and perhaps skittish nerves about this volatility that the banks are concerned about each other being able to even repay on a single overnight basis to each other. Can you talk to us about what happens when trust is lost between banks in the overnight lending market, and what has happened in the past when that has occurred, and what it may be signaling now?
Yeah, well, I mean, it's the problem with that is that it's anecdotal, and so we can't really put a finger on it. But to understand how it works, each bank will have a file on its counterparties within the interbank market. And it will set a limit. So you'll find that Morgan Stanley will have a huge, great library, if you like, of every bank that they deal with in the interbank market. So they will say, regional bank, they will say, well, within the interbank market, we're happy to enter into commitment to provide them with credit up to $10 million, say. Now, that was the way in which it always worked in the past. So, each bank has got different things. Now, what you're referring to, I think, is a situation where, in this case, say JP Morgan decides, we've had a look at their business, their accounts, and so on and so forth. We've got to cut that back to $2 million. So we're going from 10 to 2. So, that is sort of bad news, as it were. And it's desperately important that regional banks actually retain their relationships within the interbank market and don't threaten. So that's one way of looking at it. The other way of looking at it is things have evolved quite a bit since I was involved with the interbank market. You now have repos. I mean, I was dealing before repos were invented in the UK anyway, because they only came in 1992, 93. But the thing about repos is, of course, it is secured. The whole point about a repo is that you part with credit in return for collateral. And the terms of the repo are that it's reversed on a certain day in the future. It might be overnight, it might be 2 weeks' time, whatever. So, when you get tightening of credit in the market, then you find that various rates, if you like, that are associated with this lending start rising. But this principally is what the Fed is trying to do. This is why it has decided that, okay, inflation is a problem, but we've got a greater one looming in the financial markets due to lack of liquidity. Now, most of this lack of liquidity is down to two things. Firstly, quantitative tightening. It takes credit out of the market, takes it out of circulation, and effectively extinguishes it because it's no longer there. That's the first thing. The second thing is that the US Treasury has been acting sort of independently, really, from the Fed in terms of taking liquidity out of the markets. What it has been doing is it's been issuing T-bills at pace. And because the government has shut down, it's just been accumulating on the general account, which admittedly is with the Fed. But what it's been doing, if you like, is it has been taking credit out of circulation and not spending it into the economy. So you can see the whole thing tightens up. So the Fed had no option at all but to deal with this liquidity issue. And that basically is where we are at the moment. The reverberations of that we're seeing at the moment with a lot of uncertainty in the market. Because without the lifeblood of continuing credit expansion aimed at supporting financial assets, the purchasing of financial assets, then the market crashes. So you can see how sensitive all this is.
It's precarious times, and in the fourth quarter is typically a challenging quarter from a volatility standpoint anyway, even in a good year, let alone in a year where there are so many question marks, so many moving pieces. We're glad to have your seasoned and experienced perspective on that to help us to see what's behind the magic curtain that's otherwise opaque to most of us. Alasdair, if people want to take part in your Substack and the insights that you shared there, how can they get connected with that?
Well, MacLeodFinance.com, Google it, just put it into your browser and it'll take you straight there. And thank you for mentioning that, Damian, because really I think it's getting more and more important that people do understand the threats to their wealth. Wealth being basically not just the property that you own or properties, physical properties you own, but property in the form of financial assets, stocks, bonds, and so on and so forth, and also currency. It is getting really quite serious, this situation. And if you don't know what's going on, you could lose a lot. I mean, it really is that dangerous. So I'd encourage anyone to really try and learn. I mean, I'm not the only person covering this, but I hope I bring a unique perspective in the sense of being informed through experience, having been in the industry for 60-odd years, and at the same time trying to express it in language which the layman can understand. So that's what I do. So MacLeodFinance.com will take you there.
And folks, if you don't want to miss a single episode here on Liberty and Finance with Alasdair, make sure that you're on our free mailing list. Just go to our website, libertyandfinance.com, all spelled out, all one word, libertyandfinance.com. Put in your email address, click submit, make sure you confirm on the confirming email, and you'll get one email in your inbox per day. We won't share your email address with anyone. It's completely private, and you won't miss a single episode with Alasdair or any of our guests. And you'll see all our weekly specials, so you won't miss a thing. And Alasdair, as always, on behalf of all of our beloved viewers and subscribers and guests, thank you for joining us here again on Liberty and Finance.
That's very much my pleasure, DK.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for November 17th through November 24th, 2025, while supplies last. First this week, backdated 1-ounce gold buffalo are just $320 over spot per ounce. Next, pre-1933 MS63 $20 Liberty coins are just $150 over melt per coin. And finally, 1-ounce 2025 Silver Eagles are just $7.85 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.